The next technique we are going to talk about is net present value. A project's net present value is the sum of the present value of all its cash flows. So if you look at this equation here, NPV is calculated as the present value, or say discounted value, of all its cash flows, and you sum them up. In this equation, CFO, or say cash flow at time zero, refers to the cost of the project, or say initial investment, and the number is usually negative. So therefore, if you think about the later part of the NPV calculation, and think of NPV as this part subtract the amount of initial investment, or say CFO. So NPV actually can also be interpreted as the total present value of the project's future cash flows, including CF1, CF2 till CFN, subtracting, or say net of, the project's initial cost. Now, if we look at an example to calculate a project NPV, and we're using the same timeline and cash flows as in the previous example. So the initial investment is $25,000, and then you have 4 years. Each year you have the cash flow listed. Now, to calculate NPV, the calculation is just something old that we have learned from Chapter 4 and Chapter 5. And we just simply calculate the present value of every cash flow and add them up. And of course, we can use the financial calculator to find the NPV function and get the NPV result fast. So in the next slide, I'm going to show you how to use your financial calculator to calculate the NPV. And of course, we have a video posted on D2L about how to use your financial calculator, and you may want to check it out to see how to calculate NPV using your calculator. Now, if you have a TIBA2 class, you want to enter negative $25,000 as CFO, and you want to enter all these cash flows one by one from CF1 to CF2, CF3, and CF4. And here you leave all these F01, F02, F03, F04 as 1, because the F stands for frequency here. So you have one of the 8,500 and one of the 12,000, etc., etc. After you enter the cash flows, then you press the NPV button, and then you enter 12 as I. So that is telling the calculator the interest rate, or say the discount rate, is 12%. And then you press the down arrow button to go to NPV, and hit the compute button, and the NPV result then is computed as 11,297. And you can also use the TI-83 calculator and just find the NPV function and then enter the numbers like this. So once you know how to use your financial calculator, you can calculate NPV, and you have your results. Should you accept this project or reject this project based on your NPV result? Generally, we say the NPV benchmark is pretty simple. It's 0. Because NPV is about calculating the total present value of all future cash flows and then compare it to your initial investment. So if NPV is positive, or say greater than 0, that means this project is adding value for the company, otherwise it's losing value for the company. So we want to accept a project if its NPV is greater than 0, or say positive, and we want to reject a project if the NPV is negative, or say lower than 0. So back to our example, we calculated the NPV, and it's about $11,000. So do we like this project? Yes, because it does have a positive NPV. And 11,297 NPV means that the value of the company will increase by 11,297 due to the contribution of this project once the project is accepted. Now, when would this value addition occur? It actually would occur immediately upon the announcement that we are taking the project. So if the company is taking a positive NPV project, usually when they make the announcement, you can see the stock market react very positively about it. Why do we say that it occurs immediately instead of over the next 4 or 5 years? Because remember, NPV is about present value calculation. So the 11,297 is calculated on a present value basis, and so the 11,297 addition should be reflected to the value of the company immediately on, I'll say, like times 0. I also have a practice question for you. So this is question number 2 at the end of chapter 13. You're supposed to look at this timeline for this 4-year project and calculate the NPV for this project using a 12% discount rate. The result is a negative $404.10, and because it's negative, then we should reject this project. Now, speaking of NPV, we say it does have a lot of strengths. It not only provides a go or no-go decision, but it also quantifies the dollar amount of the value added. So, for example, we mentioned if the NPV is about $11,000, that means this project is contributing an additional $11,000 value to the company. NPV is not a ratio, it's about real dollar value, so it reflects the real dollar amount of value created by the project. And it also works pretty well for both independent projects and for choosing between or among mutually exclusive projects. For independent projects, it's pretty simple. You look at each project independently, and you accept or reject this project based on its own NPV. And your decision about this project will not be affected by your decision of the other projects. Now, if you have mutually exclusive projects, you want to accept the project with the highest positive NPV. We also need to mention the weakness of the NPV technique. This is actually not really the weakness of the NPV technique itself. It's more about people misinterpretation. So sometimes managers are not very familiar with NPV and they can misinterpret the results. For example, they sometimes insist that we need to compare NPV to the cost of the project, so NPV needs to be higher than the cost of project. That's actually not correct, because NPV result is already after subtracting the cost from the future cash flows, so NPV only needs to be compared with 0. As long as the NPV is greater than 0, we should accept the project. After we talk about NPV, we should also talk about another technique which is called internal rate of return, IRR. IRR is one of the most popular techniques to analyze projects, and sometimes it's just referred as the return on the project. If you think about the cost of the project, CFO, and you think about all the future cash flows of the projects, and you want to find a discount rate that matches all the future cash flows on a present value basis with the initial investment. So when you look at this equation, IRR, the internal rate of return, is actually this little discount rate I that we are looking for. Speaking of the connection or relationship between NPV and IRR, IRR is the discount rate that forces present value of the cash inflows equal to the cost of the project. So if you rearrange this equation, this means present value of the inflows minus cost equals to 0. And that means NPV equals to 0. So in other words, IRR is a discount rate that results in a 0 NPV. So when we calculate NPV, we enter a specific discount rate and we solve for the dollar value NPV. When we try to calculate the IRR, we solve for the IRR that makes this equation hold, or say that makes a NPV 0. If we want to calculate IRR, it's actually also a pretty simple task now. We now are looking at the same example that we used to calculate NPV, and let's see, to calculate IRR, we are pretty much inputting the same way as we did with the NPV calculation. Now we just simply press the IRR button and hit compute. We get the IRR at 30.08%. You notice that in this calculation we enter all these cash flow amount and then we press the IRR button. We don't input any discount rate or rate of return into the calculator for us to calculate IRR, because IRR itself is a discount rate. If we use the TI-83 calculator, just find the IRR function and enter all these numbers this way, and you should be able to get the same IRR results. Again, I do have a video on D2L showing how to use your financial calculator to calculate NPV and IRR, and I strongly recommend you to check it out. So for IRR decision criteria, once we calculate the IRR result, we must compare it to the cost of the capital, or say the investor's required rate of return, to see if the project is acceptable. So essentially this is a benefit cost analysis. Benefit is the return from the project, and the cost is the cost of capital that you have to raise to finance, or say to fund this project. And if your return is not greater than the cost, then this project is not worthwhile. So we only want to invest in projects where the rate we expect to get exceeds the rate investors require, or say the cost of capital. In our example, do we like this project? Pretty much yes, because its IRR, which is 30.08%, is greater than the required rate of return, or say the cost of capital, of 12%. You notice that we are alternating the term required rate of return and cost of capital. And that is based on what we have learned back in chapter 11, that it is the investor's requirement that determines a company's cost. So how much cost a company has to pay for the capital depends on how much investors require to compensate for the risk they are bearing. If you want to do one more practice, this is question number 9 from end of chapter 13. This is a 5-year project, and you are given the amount of the cash flows every year, and the result is also given. So check your result with mine, and the result is IRR equals to 25.49%. So since IRR is greater than the required rate of return or cost of capital of 8%, this project is acceptable. So most of the time, IRR is actually pretty consistent with NPV. That means when you have a positive NPV, at the same time, IRR will be greater than its cost of capital. But problems would occur if cash flows are non-normal. Remember at the beginning of this chapter, we mentioned about non-normal projects. Non-normal projects are projects that have change of sign in its cash flows for more than once. Right? So you have negative and then positive, but then negative later again. So problems would occur if we have a non-normal project with non-normal cash flows. And also problems could occur when we try to choose mutually exclusive projects and we rely on the IRR results. To explain this, let's take a look at some NPV profiles.